we bought the largest car wash business. This is 2006, so that's our flavor of the day now. But there's a business called Mr. Car Wash, which is a public company in the United States now. We're actually the first investors in it. We bought it. It was a $10 million EBITDA business. It had two markets, Minnesota and Houston. That was it. And the biggest risk with that kind of business is weather. And if you have a shitty weather season, it can really impact your returns. So you diversify that through additional markets and you diversify through the revenue base. But that became a really interesting roll-up type opportunity where I may forget my numbers. We might have done 25 add-ons with that, but they were small, but that was a bigger part of it. We also did that in collision repair. We own the largest collision repair business called Caliber, which I think now is like an $800 million EBITDA business for all I know. We sold these like a decade ago. But those were, the kinds of things that were almost multi-location consumer-facing businesses. And so if I think about like Fund 2, it was car washes, collision repair, restaurants, casinos. There was a lot of that. And then we had, a couple other distribution type opportunities and some other stuff. But I'd say that was probably the biggest shift if I want to think strategically. The biggest winner was our car wash business. We made 8 times our money on that. The worst was the restaurant business. We made 2 times our money. It was only 8 businesses in that fund. And that was the philosophy of the way that my old firm, we did things, right? I mean, we made a handful of investments. They weren't meant to be diverse portfolios. And we only had, we had 4 people for Fund 1. Maybe that grew to 6 or 7 by the end of Fund 1. Fund 2, we might have been up to 10. So we didn't have a huge team, right? There was a couple of us partners, a couple of junior resources, and you can't be a good partner to the companies and we didn't run the operations, but we were very involved in governance. A lot of these businesses didn't have great reporting, great systems. They're creating the proper dashboard and making sure that got put in place. Obviously upgrading talent, which was for any C-level hires, CEO, CFO, COOs, we were super involved in that. And then the capital side, which was the add-ons and the plant expansions, anything required major CapEx, like a facility expansion, we were all on top of. And that takes, you can't be a good partner and be a good steward of a business if you're on the board of too many companies. So our philosophy was to have fewer businesses that we would be very close to and that we would drive pretty hard. And it also made us a bit paranoid, right? The industry changed a bunch, but our philosophy was always fewer businesses, longer hold periods, be more thoughtful and more hands-on. I can't speak on behalf of the entire industry. I've met a lot of my peers who ran other firms who sat on like 10 boards, and I don't know how they could have done that. It's bullshit. I actually don't believe they knew they were really good partners. You can't be if you're on that many boards.